Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. All right, thanks for joining us tonight. Another Tuesday Night Podcast, and tonight we're talking about getting money. We got Beau Eckstein here. He's our money guy. He helps investors with finding the money. And guys, if you're thinking about investing in real estate, whether you've done a deal before or not, it's always a challenge on how to fund the deal. And I think everybody would want to own rental properties or get into investing in real estate if they could just solve the money part. And for many, it seems like, a daunting task. And for others, they just seem to do it. You hear people buying properties with no money out of pocket. And I've personally never done that before. And I don't know whether Beau's going to be able to help us with that tonight or not. But guys, he has some good stuff for us tonight. Beau, thanks for joining us. Go ahead and introduce yourself.
Hello, and thanks for having me. My name is Beau Eckstein. I reside in the wonderful state of Nevada. I live in Henderson, which is a suburb of Las Vegas. A formal transplant from California. Decided to move to Nevada 2.5 years ago. I had a vacation home here for many years, and I just like the lifestyle here, and it just makes a lot of sense to live in Nevada versus California, especially when you can work from your home office.
Isn't your state's like one of those states you don't pay state income tax, right?
Yeah, that's correct. So there's no state income tax. Although if you're a savvy real estate investor, you learn about all the tax advantages of owning real estate. And I've been considered a real estate professional for many years, so it definitely helps on the taxes.
Well, I think it's nice the idea of not paying state income tax. It seems like it would give you a lot more money to invest in real estate.
Oh yeah, for sure. So real estate's great because you have a lot of different profit centers. You have appreciation, you have depreciation, you have tax advantages, you have tenants paying down your mortgages. So there's a lot of profit centers, and that's why, and you can also leverage it, right? So that's why real estate is so powerful.
So tell us how you got into this wonderful career of real estate.
Sure. So when I was 19 years old, I either wanted to be in law enforcement. I didn't really want to do the college route, or into real estate. And when I really thought about it, real estate was more of my fit, more of a creative type of business, entrepreneurial, and you can make your own hours. And as many of us real estate professionals know, we think, oh, well, I can create my own hours. We end up working harder and more hours, but it's for our own business. So that's why I really fell in love with real estate at the age of 20.
I know you were in residential mortgages for a while, and you kind of transitioned and you specialize now. And guys, he has a great YouTube channel. We'll make sure that his links are published in the show notes, so check him out. But just kind of give us an idea of what made you go towards the investor or the commercial lending side of things.
Well, honestly, I think anybody that either sells real estate, is a mortgage professional, and anybody listening pretty much should own real estate because there's many advantages. And I was never very good with budgeting and managing money. And I always feel like if I buy properties, it's like a forced savings. And depending on where you're buying real estate, you get really good appreciation. Obviously, in slow times, they can also crash, but you're able to just leverage and create deal structures, sometimes with none of your own money. So when you're getting started and you want to grow your wealth, this is a tool that I think is like the best tool out there that I've found, at least.
Real estate's trending. I think there are more people that have real estate license now than ever before. Quite some time ago, I think it was New York Times published an article saying it was more licensed real estate agents than houses available for sale. I think it was like over 1.2 million licensees in the United States. A lot of people want to get into real estate. A lot of people want to get into the investing side. I mean, you have all these infomercials and seminars where they're talking about everything from wholesaling, sending out postcards. Everybody just wants a piece of it, right? And me being in the real estate industry for a very long time, I understand that with real estate being permanence of investment, the idea, ideally, is to hold on to real estate, because it appreciates. And so many people flip, and then it's sort of like a job. It's off to the next deal. Maybe you make $20, $30, $50,000. If you're lucky, more. If you're lucky, you make any money, but then it's off to the next deal, off to the next deal. All the while, real estate appreciates over time. What would you say, as someone that helps investors every day with financing, making deals happen, what would you say is the number one thing that holds people back from jumping in?
Yeah, that's pretty simple. Everybody goes on a YouTube University or these podcasts and they listen and listen and listen. They never take action. Real estate, you have to take action. And at some point, you got to get out of your comfort zone. You got to run the numbers and just analyze deals. And you got to first thing you got to do is analyze deals, kind of figure out what you have at your disposal right now. Maybe you have cash, maybe you have time, and figure out, do I want to wholesale real estate? If I'm able to wholesale real estate in certain states, you can wholesale real estate that's where you assign contracts and you don't need credit or money to do that. But in some states, they don't allow it. It's not a legal process. But many people that start in wholesaling because they don't have the capabilities. But there's a lot of ways you can be very creative in real estate, and you can structure deals with none of your own money. I've done it numerous times. So I think anybody that's listening or watching, the key is to dive in and take immediate action. You should spend 2-3 weeks diving into podcasts and kind of getting a feel of what you want to do. And then you should start underwriting deals. And there's simple deal softwares out there that you can use, and you can analyze deals. Like, I use a very simple tool. I put in the numbers, what's the anticipated gross rents, what's the annual taxes, what's the insurance, maintenance, and a vacancy factor. And this program just calculates your numbers, what's your cash on cash return, what's your IRR, your internal rate of return, and then what's your debt service coverage. So you're going to learn these vocabulary words. And once you learn that and go through and use these calculators, you get a feel of what's a good deal and what's not a good deal. And you also need to learn what markets you're investing in. Some are good for cash flow, some are good for appreciation, and some are a hybrid market. So really understanding the market that you're looking at and what would be the best avenue to invest in based on the market you're in. Or like myself, I live on the West Coast, but I invest in the Midwest and East Coast. So I have holdings right now in Indiana and Pennsylvania. And I used to be an active flipper in the San Francisco Bay Area. So it just got to pick what really resonates with you and go with it. And flipping is a good business, but it's a business. It's an active business, right? Buying long-term rental properties is a more passive business. It's a semi-passive business. And then there's also models like running short-term rental properties. And that could be a very active business because you're managing the conversations on the platforms like Airbnb and VRBO. But you can build systems and have people actually take over that workload for you. So there's a lot of ways to systematize all these real estate investing niches.
What would you say for someone who wants to get into the rental market or the buy and hold, not the flippers specifically, but someone that wants to build a passive income and gain the appreciation? I mean, maybe they'll sell it one day, maybe not. And I know we're going to talk a lot about the actual financing, types of financing that are out there. But what, and even on some of the non-bank type of loans, what are some of the biggest qualifiers that people need to have before buying something?
Sure. So it's really quite simple in today's market because traditionally you can buy properties with conventional financing. And that's a component of, they actually look at your tax returns and different things like that. But there's actually investor loans out there where they don't look at that stuff. So really what it comes down to on these investor type of loans is your credit score and the cash flow of the property and what we call debt service coverage ratio. So when I talk to new investors, I explain, listen, these loans are great, but the property needs to cash flow. Or if it doesn't cash flow, maybe you do a value add. And when we say value add, you fix the property and then you tenant it up and then you get max rents. And then the cash flow from the tenant pays your mortgage and your insurance. And basically a debt service coverage ratio is a component of taking your cash flow into your expenses, and that's the ratio bankers look at it and these lenders look at that. And basically what it says is that the cash flow is going to pay the property, the debt by at least 120%. So they don't want to make a loan to a property that the borrower would need to feed, right? It kind of makes sense. So really, it's a component of finding deals that meet the cash flow expectations. So why I chose certain markets is because they're not high appreciating markets in the traditional standard. I mean, we've gone through a good period of appreciation, but I buy properties that the debt coverage is high. Now, some investors talk about the 1% rule. And what the 1% rule is essentially, if you buy a property for, we're just going to use $100,000. I know it's very hard to buy properties for $100,000 nowadays, but that the rent should be at least $1,000 per month. And I don't really use that theory, but I think that's just a quick, like in your mind, okay, what am I buying the property and what is it rent for? What I personally like doing is buying duplexes, triplexes, and fourplexes because it's ease of financing. Once you get over 4 units, so 5 units plus, that's considered commercial financing. So there's a lot of options out there for commercial financing, but if you're just getting started and you want to grow a portfolio of rental properties, I would look at duplexes and triplexes and quads because they're easier to finance. And then you step up and you get the 8plexes, the 12plexes, the 100plexes, and you start scaling from there. So depending on what you really want to do, and then there's all different models. You can get joint venture partners. Once you grow big enough, you can do syndications. So there's a lot out there, and there's a lot to learn, but it's baby steps. Going back to the baby steps, 1 foot in front of the other. Let's start analyzing deals every day. I'll just throw this out there. This very successful gentleman said to me one time, and this guy's worth over $100 million. So I consider him pretty successful. He's grown multiple businesses, that kind of thing. And he said, if you want to do more deals, you have to look at more deals. Okay. So we get a lot of people that say they're real estate investors, but if you really look, like, what are you doing? Are you taking your business seriously? And that's the kind of like the fundamentals. But going back to the starting point, you have to start and you have to have a plan, because if you're working a 9 to 5 and you look at what's in your savings and your 401k, what's going to happen at 60 or 65 years old, right? Like, it's going to be very difficult with the cost of inflation and everything going up. It's going to be very hard to live. And that's kind of a fear in the back of my mind that motivates me. It's like, listen, I want to have enough reoccurring revenue coming in every month that I could replace my W-2 job if I had one, right? Like, so that's the key.
So you had mentioned, the 1% rule, and that's something actually, Beau, that I try and live by. I know that I've been investing in real estate for about 25 years. I've had the multifamily units and the single family units, but I find I'm really safe at that. And my 1% rule, and I guess it's different. Each asset's different, but I look at it as my 1% is everything all in. So it's not just my acquisition costs, it's my repair costs, it's my transfer fees, my recordation fees. It's whatever I have in that property. So if I have a property that I purchased for $350,000, I want $3,500 a month. I know there are strategies and the market's really pressing on that, but it's kind of hard. It's kind of hard to have a profitable business, I find, at least with having less than that 1%, because things are residential. You're not usually passing along things like taxes and insurance and things like that, where in true commercial, when you're talking about triple net and things like that, that's kind of different. So, and then I always look at, the repairs. If somebody moves out in a year or 2 years or 3 years, if I'm making $500 a month or $6,000 a year, and I get somebody that stays for 2 years and costs me $8,000 to go in and make that property rent ready again, replace appliances if I have to, it kind of sets me back. So when you're talking about you don't use the 1% model, what would you be looking at? I'm just kind of curious.
Sure. So I finally found a tool I really like to use, and it's an online cloud-based software. And so I plug in my numbers, and I go in, it gives you all the input fields. So I look at, like, okay, well, what's the debt service coverage ratio? And I usually look for at least a 1.85, where banks look at for a 1.25. So I try to get a debt coverage that there's enough cash flowing that almost doubles what the debt payment would be, right? So you know, from a cash flow standpoint. Another big tip is you go in, so certain counties and townships and wherever you're buying, they have different reassessment rules on if they assess property taxes at a point of transfer. And so if somebody owned a property for 30 years and now you're buying it for 10x of what they bought it for, is there going to be a huge tax bump? Because you want to plug that in and you want to call the county and find out that information, or get with a good realtor that's going to give you this information, because that's critical, right? What if your property taxes on a point of assessment, when they get reassessed, they went up $2 or $3 grand a year? What's that going to do? So you want to know all those things. What's your insurance going to look like? Because maybe your insurance is going to be a lot higher. So I look at that. I look at the cash on cash return. Okay, I just bought a duplex, for example, in Pennsylvania for $100,000, $106,000, right? So I went there because I like the inexpensive markets, and it's a duplex. And my gross rents, we're doing a few punch list items, and then we're going to rent it out. Big unit's going to rent for $1,000, hopefully, and the small unit for $800. No, my property manager is actually $1,100 and $800. So I'm $1,900 a month. I mean, yeah, $1,900 a month on $106,000 purchase, right? So
yeah, well, that's
I put
better than
down
1%.
Right. So
Right.
I put down 25% on a DSCR loan. So it's not based on my income. Because remember, once you get enough properties, it's a little bit harder to qualify. That's why we work with these non-bank lenders eventually. And I got a 30-year fixed rate. The rates went up over the last month pretty significantly.
Yeah.
I locked in just under 5%. I mean, when I first started, I was supposed to get like 4.25%, 4.5%, but the rates on these type of products went up significantly, as they are in the conventional world right now. And so I locked in. So at the end of the day, even putting in, when I factor in 10% vacancy factor, and I factor in a replacement reserve. So I'm always putting X amount of percent into a reserve account. So when I need to do those repairs, and then what's left at the end. So once I take the worst case assumptions, I mean, there are worst case assumptions like HVAC goes out or a roof or whatever, but that's why you're doing your due diligence in the beginning to see, are your mechanicals good? Is your roof good? The high ticket items, that's where it's really going to get you. So you got to know that. So once I put it through my my tool, I look, okay, when I'm factoring all these costs in, what's left over? And that's really, to me, is the indication. I want to get X amount per door. And so on something like this, if it goes well, even taking out 8 or 10% for property management, because these smaller properties, the managers are going to charge 8 to 10% until you get a big portfolio. And so this will pay me, probably net me $800 to $900 a month. And so then let's just say, how many months will it take me to recoup my $30,000 or my $25,000 deposit? It's $30,000 with closing costs and everything. So it's going to take me 30 months, essentially 34 months. And then basically I get all my capital back and I have an infinite return from there.
Yeah.
But the cash on cash return is basically telling you.
Yeah. So you're running it through the underwriting process, and we get there the same way. You know, when I'm looking at a property, you know, I'm checking out all those systems, and that all goes into my cost of the property. So if I need to put $10,000 in HVAC, you know, a furnace, I'm throwing that in as all money in and being spent. You know, and it's very competitive out there. It's a competitive market. I mean, I see people competing for pennies, and it's like, you know, and like you said, and that was a great point. I appreciate you saying that. There are so many different strategies. And if you're looking at property that is in very high demand, where owner occupants are really fighting for that inventory, I mean, even if finding something distressed to fix up, but if you go out where the markets aren't appreciating like these major markets, you can certainly make more money. There's lots of ways to skin the cat, but you know, I see that when the markets dip down, these are also the first places that drop the farthest and, you know, and become the most recessed. So we definitely have to be careful. I was listening to one of your shows, Beau, and you had mentioned, and you're younger than me. So when you talk about catching up, you know, I mean, I know all about that, man. But you had said that you wanted to do more, you know, you wanted to invest more and that you wanted to catch up. And you just mentioned you want to increase your cash flow. Can you think of somebody that I know you mentioned somebody that influences you when you quoted them on if you want to do more deals, look at more deals. At where you are in life right now, and you wanting to speed up the process and kind of take the quickest route, the most profitable route. For people that are listening, is there somebody that sticks out that when you started, or maybe it was even last week, doing commercial loans or non-typical bank loans, where you were like, man, that guy's smart. And, like, I didn't think about that, but that's a great idea. Is there anything that you can tell the listeners that with something that you've learned?
Sure. So you get to a certain point and you realize that you can scale up a lot quicker using OPM, other people's money. Some of my good friends and mentors, they said, Beau, there's a better way than what you're doing. You can do what's called a real estate syndication, and you can go out and file with the securities laws and all that stuff. You have the private placement memorandum, and you do it by the books, and you can actually legally go out and raise money depending on what kind of offering you can do for just accredited investors or sophisticated investors, meaning they have over $1 million net worth, and there's some guidelines what's considered an accredited investor. So my friends that are that have blown by me in real estate, they understand the power of the real estate syndication, and it's not for everybody. I mean, I might not choose to want to have to deal with bringing in investors, but I have a very good friend. He started with $7 in his pocket in India, from India, relocated to the States, used to sell Bibles door to door as a college student. And anyways, he's almost 70 years old now. I've never met a guy with more energy. And this guy, just to put you in perspective, he buys, he just bought a $50 million apartment building. And he's done that numerous times. So, and he started with a 14 unit property. So he got into the single family and the duplexes. Then he did his first 14 unit property. And then from there, over the last 8-9 years, he's become a huge syndicator and has bought in over $400 million in real estate. Now, that's not for everybody. I know other people that just have grown their own portfolio internally, meaning they don't do syndications. They might use OPM, like other people's money in deals. But they don't go out and raise money. And so there's a caveat. When you're actually raising money, there's securities laws that you have to abide by and a lot of different. So for me, I don't know if I really ever want to syndicate. It's in the back of my mind that I could probably do fairly well, because you can partner and have when you do a syndication, there's what's called GPs and LPs. General partners, they're the operators, and the LPs are the passive investors, essentially. So that's just one model. So this gentleman definitely inspires me because he's got a passion. He could easily retire now, but he wants to get $1 billion of real estate. To each his own, okay? Maybe for you that's listening and watching this right now, it could be to buy one rental at a time, okay? One rental at a time is perfect, because over the next 5-10 years, what's that going to do to your portfolio? What's that going to do to your retirement? When I looked at it, being self-employed the majority of my life, I didn't have a 401k. So you have to learn about, if you are self-employed, setting up self-directed IRAs, self-directed vehicles. You need to be a student of the game in order to get ahead in life. And that's what I truly believe. And that's why if you go on YouTube or wherever, or you download this podcast, there's many really good podcasts out there, many ways to learn, and you just keep growing. So my partner on the podcast that I do the Friday show with, he's probably one of the top inspirations and mentors in my life. And he always teaches me to think bigger. You got to think bigger. You look at the Grant Cardones of the world, they think extremely big. And most of us have limiting beliefs, and I can speak for it, and here it scares me sometimes. Even buying $150,000 properties, there's really not much risk, right? What's the payment on it? $700 a month. And what's the income? $1,900. There's not much risk there. But when you're doing it in different locations, you always have to think, okay, well, what happens if there's a problem? I need to go fly out there. I don't want to. So really what I evolved to, I guess I want to end the story with, I don't necessarily need to be my mentor, Vinny, because I don't need that. I don't need to buy $50 million buildings to reach my financial goals. But what I would do is start figuring out what your goals are. Is that $10,000 a month in reoccurring revenue? Is that $20,000 a month in reoccurring revenue? Is that 30,000? Is that 40? Is that 50? Everybody's got a different number because people have different lifestyles. So just figure out what works for you. That's the best advice I can give you but what I can tell you is that strategically buying real estate for the long term will get you ahead in life.
So someone wants to buy a rental property, and yeah, I mean, these syndicators, I mean, you know, that is a different world all in itself. I mean, you know, number one, I find people need, you better have a lot of experience doing this business if you're going to go out and raise even $500,000 for a project or a deal. The other thing is, you know, I guess what sticks in my mind with that is by having investors, you know, I mean, there's a whole lot of legal issues that can come if you think you can't pay your bill, you know, to the bank and you're getting letters in the mail. There's nothing that I can imagine worse than owing $500,000 to your family and friends and not being able to pay them back and the ship going down. But so I would hope, you know, that is something that if someone is thinking about doing, that they have at least gotten into this business a little bit, experienced it, know what it's like dealing with tenants, and things like you mentioned, the something breaking or property management and things like that. What about, so when somebody comes to you, you know, we talked about good credit and, you know, the property being able to stand on its own. And for a lot of people, when they're starting out, the property doesn't stand on its own right away. I mean, if you're buying some tenants, which can or cannot be a good idea. You know, my favorite thing that someone says to me when they come to me and are like, yeah, I want to sell my investment property, is they say, yeah, my tenants aren't paying what they should. They're not paying market rent. I mean, you've heard that, right? I mean, a million times. Oh yeah, well, you know, it's worth this much money, but I'm only getting this much money because it's, you know, they're paying below market rents. Sometimes that's true. Most of the time it isn't. It's based on the condition of the place. You're like, you look at it, you're like, well, I know why you're getting below market rents. The place is a dump. So then they have to go in there. They have to, you know, kind of juggle the fact that they're buying the tenants if they're occupied. They need to go in, they need to renovate, they need to do different things. It doesn't always cash flow. We're buying future cash flows. And a lot of times, what do you do with someone that is coming from money and they call you up and they say, Beau, I want to buy this property. I want to start landlording. I want to get involved. Kind of take us down the road of how you qualify them specifically. And then how do you know what loan products best fit them or what their options are?
Sure. So first thing I do with a new client is really, where are you right now? Where are you at? What's your credit score? Do you know what your credit score is? Do you have any money to put down? And a lot of people come to me and they are lost. If you're a newbie, it's a different conversation because sometimes I get a call from somebody that's buying a $30 million building and they're not a newbie. And so it's I can handle either scenario. And I've taken a lot of people from owning no investments to owning lots of investments just through what I call strategic financing or strategic coaching in the financing world. So I listen to what their goals are first, right? Because it's this, okay, what are you looking for? Usually they have a property in mind, and then what is your objective? And then I give them possible ways to structure it. Maybe they have the capital to put down, and so let's just pretend they have the capital for the down payment. Okay.
And let's just talk about a scenario, like what
Sure.
type of capital? Like they're looking at a place that's $250,000.
And let's call it a duplex.
Sure.
Okay, so duplex, 250,000. So first thing first is introductions, get the property address. I pull it up usually I meet with people over Zoom. I pull it up on the computer. I look at the property and then I go into the details. Okay, you're buying it you could potentially buy it for 250. Is it currently rented? Do you need to do any rehab to the property? What are the annual taxes? What's the annual insurance? Okay, it's vacant. Okay. All right, what kind of rehab are you going to be doing? Is it significant or just kind of a cosmetic? And then let's just say they're buying it for 250 and they want to put in 50 grand to bring it up to par and it's vacant. So at that point, I'm like, okay, I think I would look at what's called the bridge loan or a fixer upper loan. And we go in and we get money for the purchase price and the renovations. And so I can fund anywhere from 80 to 90% of the purchase and 100% of the repair costs. Very high leverage. The gross loan amount cannot exceed 75% of the completed value. So what I do on these type of deals is I get your scope of work and your construction budget. So for people who don't know what a scope of work is, it's just the narrative of what you're doing to the property, the level of finishes, and then the construction budget is a line item budget, which shows demo, electrical, plumbing, that kind of thing. And that was itemized. I take that. I found out if you have any other real estate experience. If not, it's okay because I can fund newbies on these type of programs. So these are short-term bridge loans. So you get in, and the idea of these 12-month loans is you either sell the property or you refinance out. So what I would do on this one, so let's say they're putting in 50, they're buying it for 250, and I go, well, obviously you probably think it's going to sell, it's going to be worth more because you wouldn't be buying it unless it was just a pure cash flow play. So then, yeah, I think once it's fixed up and rented out, it should appraise at 375. And then, so that's why on something like that, I would advise for a bridge loan. So we go in, we can get the highest leverage possible, fix up the property, get leases in place, and then we refinance out. And then at that point, and this is what we call BRRRR, buy, renovate, rent, refinance, repeat, right? You can systematically start with a little bit of money and keep on doing this. One house, one duplex at a time.
And you were saying 15% down on the original purchase price, right? Is that what you said?
Yep. And then, so now you have a property worth more, and then we can go 75% on the refi, on the cash out, assuming the debt service coverages.
Mm-hmm.
So I think most people don't have a surplus of cash. Like they have a certain amount of money that they have, and they say, okay, Beau, I have $100,000. I want to do my first property and use this rinse and repeat strategy. So I can like every 6 months, I could be working on one deal and then get it occupied, get it cash flowing. So that's basically the strategic coaching I do. And sometimes it's on large multifamily, but really, if you have a limited amount of money, you really want to look for these type of value add properties or a property that's cash flowing. So that's a bridge loan. After we renovate, we put tenants in, we refinance, and we try to get as much of your equity or your cash in out. So then you can rinse and repeat. Okay.
But still not more than, in this scenario, 75% of what it's appraised finished value. Right. Some people say ARV, after repair value. You made a good point. When you mentioned that you need some kind of a budget, construction budget, what's it going to cost for repair? I can't tell you how many people that I have that call me and they're like, yeah, I'm going to put $50,000 in it. You're like, how did you come up with the $50,000? And they just say, it's just what I think. It's just, what it's just what I feel. It's like, oh, do you have construction knowledge? Not really, or I've, have done home projects before. What you said is very important. I mean, guys, you if you're listening, it's probably the most important thing in investing in real estate. You have to know what costs are. And so my recommendation is, take a contractor with you. If you really aren't a contractor yourself, when you're looking at these properties, have a really good understanding. Even if you have to pay somebody $400 or $500 to go with you to kind of estimate these repairs, because Beau's going to need them. He's going to need line items. And when he's qualifying you for a certain amount, that's what he's qualified it based on those numbers. So, and I want to talk about different loan products, and I want to make sure that we cover this Freddie Mac loan product that's out there, because it's an amazing product. With the deals, most of the deals that you're doing, in a scenario that we just mentioned, where it's a bridge type of loan, where you have a sort of like a construction part to it, you have a purchase portion, component, and then you have a repair component to get it to that, after repair value or those estimated rents, and to get qualified. In these scenarios, is the investor allowed to be the general contractor? Or do they need to hire a licensed contractor? And when they're giving that, list of repairs, does that need to be from a licensed contractor?
If you're doing substantial rehab and you're newer, they're probably going to want to see a licensed contractor. If it's a cosmetic remodel, carpet paint kind of thing, it's okay not to be licensed. You can outsource. So the flips I've done that I've enjoyed the most, I've done $2 million projects in San Francisco. I've done acquisitions of $20,000 properties in the Midwest. So I've done it all. And what I prefer is the lighter cosmetic fixes because I want to be able to rent out quicker. If you're doing a huge value add project, and the problem that I see on 8 out of every 10 deals that I do is everybody thinks they can do the project quicker, and they always go over their budget by 20 or 30%. Very few people actually stick within their budget in these kind of smaller fix and flip. I mean, when you get into really, really high level construction, and you have the right construction managers, and they're usually a little bit better equipped. But a lot of the real estate investors are a little bit fly by the night, and prices go up, as we know, because of inflation and supply chain issues. But that's usually a problem. So whenever you're factoring these, you always want to put a contingency in your construction budget for these kind of overages, change orders, right? What's a change order? It's when you make a design change and that wasn't accounted for in your budget. Now it's going to be an extra $5,000 because you're doing a different layout for the kitchen or whatever that is. So that's change order. Yeah. So really, that's the biggest problem I see, is that it always takes longer and costs more. And so think worst case scenarios on your evaluation of deals.
Now, when you're talking about refining when the project's done, and a lot of my deals, I'll go in, I'll pay cash, and then refi it once the whole thing's done. And that way I don't have to deal with the bank. I don't have to deal with draw schedules, inspection fees, things that come along with financing for the construction portion of the deal. And a lot of times when I do that, if we're strategic and I'm a capitalist, right? I mean, I want to try and find those deals where the 75% pays me just about 100% of my money back. I mean, they're the sweet deals. But for the people that are starting out and they're relying on the acquisition finance cash, the renovation financing, because they're limited with their cash starting out most of the time, when you say to refi it, is that typically because they're able to obtain better financing? Is there any construction to perm products that you recommend for people that are starting out that where they would not have to refi? And because refinancing costs money too. I mean, that's an added expense that you have to plan for as well.
Sure. Great points. And you're exactly right. I love leveraging. If I had more cash in my bank, would I pay cash and then wait on these projects? Probably. But I find if I have, I'm closing on another property at the end of the month. So I always am looking for properties. So I always want to keep cash available for the down payment. If you own $10 million of real estate versus $1 million of real estate, and you have a appreciation of 3 or 5% a year, you're better off owning more properties, right? And instead of owning
I don't disagree. No. Yeah. I mean, don't get me wrong. When I'm using cash, it's solely for getting the property ready to be refied. And for me, it's the competitiveness too, because a lot of times in this market, when you're going with a financing contingency, the cash guy's beating you out almost 9 times out of 10, So no, I'm with you. I want to try and get it refinanced as quickly as possible so that cash is working.
To answer your question on the construction of perm, I mean, there are banks that do construction of perm on construction deals ground up. On the renovation side, there is, if you're owner occupying a property, there is like home style renovation loans where you can get really high, good leverage for owner occupied. I'm really in the investor space though. I'm already calculating in the cost of the money in my deals. I wouldn't buy it if it was too tight. Now, if I did have money and I didn't need to deploy it anywhere else, would I use my own cash sometimes? Sure, because it makes sense because you're saving a couple grand, right? And that's significant. And especially if
and getting a deal in some cases, which is more than a couple grand.
Yeah, so that is a consideration. Typically on our deals, once you get to a certain level, you pretty much know, and you have a relationship with multiple lenders, that your offer is as good as cash. You already know what to expect. I mean, there's not many variables in these type of loans, and assuming that your ARV, even if your ARV appraisal comes in less, your appraisal subject to completion appraisal comes in less, it just means you have to put a little bit more down. I have friends that have the cash and they always use leverage. Always use leverage. There's so many ways. Just to give you an example of how I've structured many deals. So after 2007-8 crash, I was left in a bad position. So I'm like, how am I going to do this? I got no money, got bad credit. So I went out and I found a contractor that would do things at cost, and he became a partner. And then I found a money partner. So there was 3 partners, and I would orchestrate the deals and never put any money up, and I'd get 33% of the profit every time. So it was awesome, right? Because I'm leveraging the contractor because he's doing things at cost. I'm leveraging the money guy, and he's happy because he's getting a great return. And I'm just the deal orchestrator. So I've bought numerous deals with none of my own money.
Yeah, that's awesome. I've done that too. For 10 years, I would build houses, renovate houses, and I had a partner, and he was the contractor guy. I mean, I was a contractor for 30 years. And started out in 1989 swinging a hammer. I mean, I've been in this business for a long time. And for a good 10 years, I had a partner. I brought someone in because it's funny, as your business grows, I love building things, but as your business grows, you actually end up doing less of what you love and more of the administrative and the business side of things. But it just didn't make sense for me to be there on the job site swinging a hammer anymore. So I brought in a partner, and just like you said, he would be the guy that would manage the subcontractors. He worked on site too. And then we split the profits, and we were both 100% honest and open with each other. And I mean, it works out. Partnerships can be tough. I say that one of the only ships that sink is a partnership. But if you can find, somebody and just make it limited, yeah, that's great. Talk to us about this investment property mortgage that Freddie Mac offers. And I just, before you dive into that, for you guys listening, when you're investing in long-term rentals, what happens is when you're getting financing, a lot of times they are balloon payment type loans. So when you get outside of the world of living you're not living in a property, you're a non-owner occupant is what it's called. You buy that investment property and you're not living there and you're renting it, strictly a rental property. And most banks consider that commercial financing, even though it's residential. And so a lot of these loans that I've had through the years, utilizing bank money, kind of the scariest part of that is that the banks don't want to lock you in for 30 years, like a mortgage where you live, for your house. So a lot of times people will buy a house with a 30-year mortgage. They'll move on. Maybe it's a smaller house, townhouse, row house, whatever. And then that becomes a rental property. They hold on to it, and then they go and buy another house with a 30-year mortgage. But when you're actively investing in real estate, what happens is you're looking for commercial type lenders that are giving you money based on non-owner, occupied status. Like I said, what happens is they will lock you in at an interest rate for a period of time, and they'll amortize, meaning stretch the actual payments out like it's a 25 or 30-year mortgage, but in 5 years, your payment's due, all of it, unless you refinance or re-sign with that lender. And at that point, your interest rate can change. So in where we are right now, that's the scary thing, is that interest rates we think are going to go up. How much? Who knows? I mean, back in the day when I started buying houses, it was 7.5%, 8%. In the 80s, it had gone up, I think, as high as 18%. So when I look at a lot of people that come to me, they're interested, Beau, in this investment mortgage program that Freddie Mac has, and that you can have up to 10, I think, per borrower, right? You can have up to 10 of these properties, up to a 4-unit. So theoretically, if you bought 10 4-unit, you could have 40 doors in this program. Can you just talk about that program for a minute?
Sure. So the residential lenders, there's Freddie Mac and there's Fannie Mae. They buy these loans in the secondary market, and so that's what we call a conventional loan. They also offer financing for non-owner occupants, and so when we're talking about these type of loans, it's a full document loan. So you're going to provide your W-2s, paycheck stubs, bank statements, that's so forth. A lender is going to take your loan application. They're going to run it through an automated underwriting system. And this is called a desktop underwrite typically. And it's going to spit out like an approve eligible. And from there, you're approved. And then appraisal's ordered. And then it goes into a formal underwrite once the appraisal's in. And then hopefully it's approved there. So in conventional in non-owner occupied financing, you can have up to 10 properties. But once you get what the problem is once you get more than 10, then you have to start working in the different realms, either with banks or credit unions or my DSCR programs. I work with everybody. I work with banks, credit unions. I place all sorts of loans. So, but in the beginning, I believe that these loans are usually superior because the rates are better than the other DSCR loans. Now, the downside would be if you're self-employed and you run losses, you're not going to get a conventional loan approved. But if you've got solid W-2 income and good cash flow, the guidelines for conventional financing for non-owner occupied properties, they only allow for 75% of gross rent. So even though you might be able to have 10 by guidelines, because the way they underwrite, you might maybe on your third property, your debt coverage or your DTI, your debt to income, is too high. That's when you start having to work with DSCR lenders. I like DSCR loans because the lenders make the loan to your LLC and then you sign as a guarantor. So it doesn't show up on most of the time, it doesn't show up on your personal credit. But getting started, the highest, best leverage is usually the conventional loans. And then once you grow your portfolio, there's many options. So depending on the situation, Freddie and Fannie conventional type loans are really good. So every situation is different, but yeah, that's the cheapest cost of capital would be a non-owner occupied conventional loan for sure.
You know, you just said something that is a really valid point. So when you said it's a great way to get started, but can you actually achieve your 10th property? That may be a little bit more challenging because when you say that loss runs, and we're not accountants here, and you know you deal with if you're listening and you have your tax professionals advise you, but I do know that one of the benefits of having rental property is that you can actually get into, you know, by the time you're depreciating the structures or doing some type of cost segregation, some type of accelerated depreciation, it can cause you to actually show losses on your income taxes. So I think, Beau, that's what you're referring to, right? As you're going down the road with maybe Freddie Mac, they may be looking at that going, oh, wait a minute. They don't understand. They don't want to see all those things. Is that what you were kind of referring to with that?
Well, yes, that, and also the fact that right off the bat, if that rental property makes $1,000 a month, they underwrite it at $750 a month.
Okay.
Or $750 a month. So you're automatically getting dinged on their underwriting. So like, you know, most properties, if you take a 25% haircut, you're going to be break even or losing money on paper, but you're really making money. So that's why conventional financing sometimes is screwy.
Yeah.
But that's why there's this whole world of DSCR, non-QM, because more and more people are self-employed and they're like, hey, I got great credit. I make tons of money, but listen, I don't show that much because I write off everything. That's the conversation I have all the time.
Now, just staying on Freddie Mac for a second, because, and I know, I mean, guys, look, Beau if he can't help you directly in the state where you live, he could probably point you in the right direction. So all of his information is in the show notes. Can't encourage you enough. Check him out, man. Listen to his podcast. This guy knows his stuff, as you can tell. So I just want to stay on Freddie Mac for a minute because I do know people that have utilized this investor program. One of the nice things is that it's locked in. I mean, you're not like when I was giving you the scenario in 5 years, you're going to have a balloon payment, or if you're lucky enough to negotiate 10 with a bank where you're a solid borrower and they have an appetite for this type of investment, which is another conversation in itself. You need to find a lender if you're going the bank route that even wants residential loans on their books, because some don't, especially if you don't have experience. They may not. But you do get a 30-year lock-in on this kind of thing. It's a great loan. But Beau, one of the drawbacks that I hear too from the investors is that, and here's what comes into, because we haven't even touched on this. This is another podcast. We could talk for hours, but ownership, how you own these properties, to best protect you, things like that, depending on what kind of personal assets you have against lawsuits and things like that. But so a lot of people want to set up long-term investments in LLCs or some type of company. I don't think with Freddie Mac, in fact, I'm almost 100% that they don't allow you. You have to buy it in your individual name, correct?
Correct.
And I hear people say later. Are you familiar with that? Is it easy to do when you have a Freddie Mac loan? Take it out of your individual name, putting it into an LLC, for instance?
Well, yeah, I mean, in theory, I would just say conventional loan, because there's Freddie, Fannie. Okay. So there's Freddie and Fannie. They buy about 64% of all the residential type of loans. But then there's also regional banks, community banks, and those aren't Fannie and Freddie type of loans. They lend their own funds, on those type of loans. But typically on those type of loans, they make the loan to your personal name. Now, most of them let you vest in what's called the living trust. So, that's another topic, but most properties probably should be in some kind of trust if you're owning it in your own name, because if you or your spouse dies, then if it's not in a trust and there's no will, then it's going to go through probate, and there's probate costs and everything like that. And it's amazing how many people don't even know that. So that's like, get with your estate planner, your tax attorney, estate attorney, because you should probably look at putting your personal assets into a living trust first off. So, but they don't allow for you typically to move to an LLC. And so that's another advantage of these other investor type loans. And the DSCR loans, they're also 30-year fixed loans. They're all straight 30-year fixed loans. So the difference is sometimes a client comes to me and they have a portfolio of 6 or 7 rental properties, or 10 or 20, and I'm looking to source the debt for them. And they want to take these and do one portfolio loan on these 10 or 12 single family homes. So I'll source the debt with some of my credit union partners and banks. But typically they're a 5-year fixed or possibly a 10-year fixed, amortized over 20 or 25 years. Versus a conventional loan, this is 30-year AM, or a DSCR loan, so 30-year amortization. The longer the amortization, the better, right? Because it it makes the payment less, which means you have more cash flow. Obviously, you can always double down and make extra principal payments and pay down your mortgage quicker. And now it's cool. I just refinanced my house conventionally, my owner occupied house, and the servicer has a tool in there. If you pay X amount of principal more, you're going to pay your down. So now the good servicers and the good lenders out there for the owner occupied houses, they actually have these in there, and I can put like a $200 principal, and I can pay my house down instead of 30 years. I can pay it down in 23 years. Although for me, I'm in my phase of growth, so I want to leverage everything that is an appreciating asset. So anything that's appreciating, I want to leverage, because that's the fastest way. It's the same principle. And that's why I love real estate, because if you have $1 million of assets and it goes up by 10%, the average homeowner last year across the U.S., and don't quote me on this, but it's the average house went up by $50,000 last year. So yeah, over the last 5 years, anybody that's owned a home has made some serious appreciation. So what do? I harvest the equity out of my house because it's just sitting there. I redeploy that money into investments that are paying me cash flow. Rinse and repeat until you have your financial independence number. That's the key. What's your monthly outgo? Food, restaurants, entertainment, mortgage, rent, cars, lifestyle. What does that add up to for you? Software systems. Let's just call it costs you $7,000 a month. First thing you want to do is start building towards $7,000 a month reoccurring revenue. Okay, now you build it to $9,000 a month reoccurring revenue. You're now making more than your W-2 job. That's when you can start slipping away from your W-2 job if that's your goal.
Yeah, and doubling down.
And doubling down in the real estate.
That's
or
right.
you just keep your W-2 job and you like what you do and you just add a rental property. Everybody's got a different mission in life. So
or continue to work your job and still double down, right? I mean, if it's working for you. I mean, if you're adding that kind of passive growth, keep it going, man. This is amazing, Beau. Thank you so much, man, for your expertise, your wisdom, and so valuable.
Oh, you're welcome. It's fun. I like talking real estate, and I think it's everybody out there should be just tuning in and learning, right? Tune in, learn, and just think about how you can leave family legacy, and that's important. As I still feel like I'm 20, but I wake up and I go, I'm 44. I'm a middle-aged man. How did that happen?
Yeah.
Right? And so what?
Wait another 10 years.
Yeah. So what are the goals, right? So you set your goals and you go, how am I going to get to where I want to go? And for me, I want a place in Mexico where I can go 2 or 3 months out of the year. So what's that going to take? It's going to take some cash because you can't really finance properties there. And so you got to create these roadmaps so you can get to where you want to go. And most people out there that I talk to, it's all about financial freedom. They enjoy their life. They love it. They're just like, I just need to figure out my life. And it's all cash flow related.
Well, that's awesome. Well, guys, we hope that you received a ton of value in this show. And if you did, give it a thumbs up. It will definitely help the algorithms push this video out to more people just like you that need to hear some good sound advice on how to get in the investment real estate business. And guys, it is certainly one of the best ways to hedge against inflation because over time, real estate continues to rise. Guys, we appreciate you watching tonight. Till next week, see you soon.